Hi everyone, and welcome to this evening's session, or at least it's evening for us, for David and I here in the UK. And apologies for the slight delay in starting, but we're actually in a completely different environment from the one that where we usually broadcast from. We've got new machines, a new completely different internet setup, and it's a bit of well, it's the first time we've tried this, and hopefully, fingers crossed, it all works perfectly well. So as I said, thank you so much for waiting. Welcome. I'm just checking over at David's screen, and you should actually be able to see the disclaimer, which is what we always start with, as always. Trading, whatever market you're trading in, can be a very risky business. So please don't even think of using money that you cannot afford to lose. If you've been coming along to these sessions regularly, you'll know that we tend to focus on stocks, particularly the US stocks, the indices, and some commodities. And basically, as you know, and if you haven't been coming along, it's where we look at the methodology that David and I have been using, well, ever since we entered the markets over 20 years ago, which is volume price analysis. And I know we always get a lot of visitors to these webinars who've actually just bought the book, which is fantastic, and it's you know, it's lovely for you to take the time out to come and join us. But if you haven't, and you've maybe not even come across volume price analysis before, this is where the methodology is explained, certainly the first of the books, and it's up there on Amazon. And I'm very, really proud to say that it has over 275 five-star reviews. I really do believe, and you know, the emails I get from traders and investors, that the methodology has really made such a difference to their trading and investing life. And the book is now accompanied by a companion, in as much that there are examples of the methodology. It was something that readers were always writing to me about and say, look, the book is great, really understand it, really has made a difference, but you know, what about some examples? And that's what this book is about. There's 200 examples, primarily stocks, some commodities. There is a Forex one, but it is a separate book, and there's also a book called Forex for Beginners, where the methodology is applied to the Forex market. And as I said, in this session, we focus on stocks, commodities, and the application of volume price analysis on the NinjaTrader platform. We also use the indicators that David and I have developed to support our VPA methodology. And I know we also have visitors to the room who have bought maybe one or two indicators, or the full package of indicators, which is again lovely. We can ask questions. It's a kind of the opportunity for you to ask us questions about anything about VPA. If you have the indicators, to ask us about the indicators. If you're thinking about the indicators, at least you can see them at the live edge of the market. And as always, I've got David. He's actually sitting sort of at a right angle to me, and I can see his screen, but he can't see mine. So I'm just going to pass over to David, and we'll start.
Thanks, darling, and a very warm welcome to you wherever you are in the world. Good to have you with us, and hopefully with this new setup, we are coming over loud and clear. It's all a bit new. It's rather like using a new studio for broadcasters. So if we do make mistakes, then that's the reason why. It's not because we're nervous or anything else. It's just the fact that we're a little bit, the technology is new to us that we're actually using in this particular environment. So do bear with us for this particular session. If this is the first time you've come along to us, we do focus, as Anna said, on the NinjaTrader platform. Anna's actually got NinjaTrader 7. I've got NinjaTrader 8 because the indicators work on both platforms. And if you're thinking of investing in the indicators, the choice is yours. You can choose whether you want to run on NT7 or NT8. It's entirely your choice. They work in exactly the same way. If you have any questions, please just drop them in the chat box. Happy to answer them there if they're short questions. And if they're longer questions, we will answer them on air for you. So do ask us whatever you have in your mind. Pass back to Anna and we will get going. And I've got, as I say, Anna's got a load of charts running on NT7. and I've got more of them running on NT8, so we can flip-flop between the two.
If you've been coming along to these sessions, you'll know that we've been looking at stocks and how one of the things we've mentioned is one of the different ways that you can select stocks and what should you be looking for if you, and here we are talking about primarily trading. VPA is applicable really to whatever market you want to trade or invest in, whatever instrument. But what we want to sort of narrow it down to, we really want to look at much more screening for trading purposes, and even more so primarily as a day trader. So once you have decided that you're going to be a day trader, and we're only going to look at day trading for the time being, we'll move on as we do more and more of these sessions, and we'll look at the other selection criteria, if you like, if you're going to look at options, and you're going to look at maybe investing. But for this session, we're going to look at some of the, as I said, the criteria that you have to look for if you are looking to trade stocks. And what are you looking, how, because there are, out in the US markets, there's thousands of stocks. So let's just focus on that. And it's something we've been speaking about, we have referred to it in previous sessions. And to date, all we've really looked at is we've looked at what we call the 2% thumb rule, where anything that's moved 2% up or down on the day, because obviously as a trader, you'll be looking not only to buy, but maybe to short a stock. Now, that may be shorting directly, or you could be looking to maybe to use buy a put on it. We've just been looking at the 2% rules, but there are other parameters that you may want to consider. And I know I've got the dollar index up here, but we'll refer back to the dollar index later. And the program that we've been looking at, or the site that we've been looking at, is FinViz. And those of you who've come along will know this. And we suggest you go off and if day trading stocks is something that you're looking to do, is to look, because you've got any number of filters here, and you can see the filters I've put up are very different. I've added more filters to the ones where we normally put up. We usually put up something, as I said, just the 2% rule. And I can just, because what I've added this time is I've added a market cap. I've added the average volume. In other words, what is the average? This is on the day, by the way. So we're looking for something that's over 500,000. What the relative volume is, and relative volume is basically, is relative to what is the norm, if you like. Because what you don't want, if you're looking to trade anything, as a trader, we actually want things that move, because you're not going to be in it for very long. You're not looking to invest in it. So you have to try and find some way of finding a stock that is that the volume in its trading session is higher than it would normally be. So I've just put in 0.75, but there's if you flick down here, there's all sorts of values, and if you pay for FinViz, you can customize it as well. And what I've done here, I've also put stocks that you can take an option on and you can short, and I've actually filtered even more to anything that's over $10. And I've deliberately done that because under $10 we're really talking about pink sheets, like penny stocks. They are very volatile. Now, having said we want volatility, we want the right kind of volatility. And the problem with penny stocks or pink sheets is they can give you huge profits, if you like, for a very small amount. They could move hundreds of % a day. But just as you can make lots of money, but you can lose lots of money equally. So I've gone for over $10. Now, the other filter I put in here is the float. And is this something that David's going to explain a little bit when I pass over to him? and it's understanding the floating supply. We actually cover the floating supply in the Forex program, not because it has a direct relevance to the Forex market, but it helps you understand Wyckoff's first law of supply and demand. But if you are in stocks, it's really important that you understand what is the floating supply that is on that stock, because depending on whether it's high or low, it will also tell you whether the time it's going to take to actually move that stock either up or down. And as I said, but that is something that David is going to look at, explain a little bit later. And in fact, having applied all these filters, these are the stocks that actually came up, and by coincidence, the first stock that came up is Alcoa, and I think that's one of the ones you've got, David, and it's one of the ones that David has got, and I was doing the we were doing this completely independently. I was setting up my filters. David was looking for stocks, and blow me down, we actually sort of met in the middle. But so that's what we're going to focus on in this session. But before we do that, can I just sort of backtrack a little bit and say, obviously today has been a very dramatic day on the market, certainly for a Monday, and it's obviously Thanksgiving week this week as well. And I think I said last time that it was been very volatile up until the end of last week, and I also said expect it to be even more volatile, certainly in the run-up to Christmas, and today has certainly been that. All sorts of reasons for it, and which is why I had the dollar index up. There's a lot of talk by various Fed members as to whether the market has interpreted that the Fed may not keep to its interest rate path. In other words, how many increases in interest rates they are likely to put into effect. There is this interest rate rise which is sort of factored in for December, but it's the ones for next year. And today there was some housing data in the States which came in way below expectation. The dollar's already been selling off since Friday. And there's all this in the background, which is why we've had this quite steep fall in the US dollar. With the steep fall in US dollar, the gold has sort of perked up, and all the commodities, other commodities, have perked up as well. And it's the background that you have to be aware of, because the stock market has also sold off quite heavily. The indices have been particularly badly hit today. But from a trading perspective, I'm not looking at it as an investor. If I were an investor, I would be probably tearing my hair out and thinking, oh my goodness, what on earth has happened? But as a trader, today is the kind of day that I really live for as a trader, because honestly, if you can't make money trading on a day like today, then you are going to struggle. But can I pass over to you, David? Is that okay? Fine. So that's what I wanted to say on that. Let me just bring that down. So bring that down as well. Here we are, back to Finviz. Shall I just move over to you?
Yeah.
Fine.
It's all right, we're struggling with technology here. It's all right, we are still here. There we go. Just show my screen. There we are. And I've even remembered to switch my microphone on, which is a minor miracle. Just move that out of the way. Let me just see if there are any questions. No, I think we're okay. So I'll just pop that out to the right, just out of the way. If you've been coming along for a little while, then you'll instantly see that what I've done here is I've actually completely revamped the workspaces. And the reason I've done that is because it really highlights one of the core fundamental principles. And I will talk about as Anna mentioned, the floating supply, but what I wanted to focus on was really just the markets today. This is the ES, this is the futures contract for the S&P 500. We're on the December contract, and it's quite scary actually, because some of the commodities are now moved to January, so we're in 019 already. And the reason I've created this is days like this, as Anna said, are just money days. They are days when it's just, I was going to say it's easy to make money. It's never easy to make money, but it's straightforward. There's nothing really very complicated about days like this. And you're almost spoilt for choice, whether you're in the forex markets, whether you're in the futures markets, whether you're in commodities, indices, currencies, doesn't really matter, or stocks. There's price action moving all over the place, and it's moving strongly, and it has been pretty much for the whole of the session. So what I've done here is I've actually created, this is the same contract. You can see this little yellow square here is the instrument link. So these are all linked. It's one of the nice features of NinjaTrader. If you change from one instrument to another, these will all automatically change as soon as you type the instrument in. And what I've also done is created multiple time frames. So we've got the 5 minute, we've got the 10 minute, we've got the 15 minute, and down on the bottom row we've got 30 and 60. And finally, over on this right hand side here, we've got the daily chart. And it's all the same contract. And the reason I've created it like this is because it really does reinforce the whole issue of using multiple time frames. And it doesn't matter whether it's a multiple time frame on a chart or whether it's a multiple time frame of an indicator. The principle is exactly the same. And this is just a really nice example. I'll pop these up full size so you can see them a bit better. This is the 5 minute of the ES. And as you can see, it's been pretty much downwards momentum throughout the session. We've had minor pause points, minor reversals, but then that's part and parcel. We've now got to this point here where we're trading around this yellow dashed line, which is the volume point of control. So the market is now in a congestion phase. The market has reached a state at which price agreement has been reached. In other words, there's no particularly strong bias to one side or the other. And that is why we're oscillating around the volume point of control, the yellow dash line. And as you would expect, the longer we're here, because this is representative time, the longer we're here, then the greater will be the concentration of volume here. In addition to that, above we've got this very strong region of price resistance overhead, as denoted with the very solid blue dash line. That is price support and resistance purely denoted through the prism of price. In other words, the only factors that are used to calculate those levels are traditional support and resistance using price. And what the volume point of control does is it then takes volume into the same area where we use volume regions as support and resistance, as well as price-based regions as support and resistance. And what's happening here is we're building a huge volume profile here. The maximum area is at the volume point of control. And up and down on the right-hand side, we have these low volume nodes. Now, if the market breaks to the upside, the important thing from a trading perspective is once it gets to these regions, you would expect the price action to move through pretty quickly. If it gets to an area like this, for example, lower down the chart or higher up the chart, then that is going to cause the market at the very least to pause, possibly reverse, but certainly pause and not move through there very quickly. The other point I wanted to highlight just on the multiple time frames is really to cast your eye down to the bottom here of the trend monitor. This has been steadfastly read pretty much throughout. We've had minor blips where the market's paused, where the trend monitor has transitioned into a darker color, but throughout this phase of price action, it never transitioned. Now we're starting to see a transition. We've gone into blue. So you're seeing that on the 5 minute time horizon. If I pop up the 10 minute, you've got a similar sort of thing happening. You've seen that transition there from the darker red into the darker blue, and now we're into brighter blue. This is a function of what the trend monitor does. It's trying to signal when those changes in trend are occurring, and not to flag up these pause points where you get these secondary reversals against this is the primary trend, the bearish trend. You get these secondary reversals, a secondary pullback. The market retraces against the primary and then picks up the primary once more. And indeed on the 10 minute here, you can see that around this region here, where we now pause at the volume point of control, we had quite a big increase in stopping volume. The volume was coming in here. The buyers were stepping in at this point, and denoted by the depth of the wick and associated with the amount of volume that's under that particular candle. One candle and one piece of volume price action is never going to cause a market to reverse straight away. It does very, very occasionally, but generally speaking, what you're seeing now is pretty much what you expect to see. The buyers come in, denoted by the depth of the wick and the extreme volume that's come in fact, the highest volume of the session. That's then followed up with an equivalent, but on lower volume. That's fine because the volume is now being mopped up. The sellers are being absorbed into the price action, and that whipsaw price action, which you see here, is classic of a congestion phase. And of course, you've got the volume point of control here as well. So everything at the moment is leading you to the conclusion that for the time being, we are in a congestion phase. There's no strong bias to one side or the other for the time being. And in addition to that, we're also coming towards the end of the session. So volume is going to fall away naturally because it's the end of the physical session, and the Globex will take over and volumes will fall away as they have done to these sorts of levels over here where we're just running on the electronic. But you can see the trend monitor here has transitioned. If we move up to the 15, what are we seeing on 15? Exactly the same sort of price action. We've got congestion, we've got the volume point of control, we can see the stopping volume coming in here, but the trend monitor on this time frame has not transitioned to blue. It's dark red at the moment. It hasn't even gone to a darker blue to signal the fact that we're moving into a potentially bullish phase. And if we step down onto the 30-minute, the bottom left, then exactly the same can be applied here, but note that the volume point of control on this chart is much higher up. We've gone through this low volume region very quickly. We're now starting to build volume in this area. The trend monitor has not transitioned at all. It's not a flicker. It's still holding red. And that really encapsulates the issue, and this is the 60-minute just to round off. And as you would expect on the 60-minute, no change whatsoever. We're still heavily bearish on that particular time frame. The lessons that you draw from that are really that in focusing on what it is you're trying to do, it's so important to narrow your field of view, because what you see on one time frame will be very different to what you see on a slower time frame. And what you're seeing in a sense on this particular array is, we've referred to it many, many times before as dropping a pebble in a pond. It is the ripple effect. What you see on the fastest chart we've got here is the 5-minute. What you're seeing here is a perfectly tradable opportunity. There will be scalping traders in there, and this is quite a decent move. This is the ES, where most index traders will be looking for a point, 2 points, 3 points, 4 points on a day is a good day for them. And here we're going from, where are we, 2682 up to 2700. So this is a big move. This is 18 points. So that's a decent move for an intraday trader. So for an intraday trader, this is an opportunity to the long side. They will have been looking for that, waiting for it, looking at the volume profiles, and then possibly taking a long position, which was very much against the dominant trend at that particular point. Nothing wrong with that, provided they're cognizant of the fact that they're probably trading a reversal against the dominant bearish trend for the time being, but that's perfectly fine. Exactly the same might be true of the 10-minute. You see the buying coming in, patience, you decide to take an opportunity, maybe snick a few points out here, that's fine, against the dominant trend. You know the risk on the trade is higher, nothing wrong with that, absolutely fine. But then out into the slower time frames, in inverted commas, of the 15 and down to the 30 and down to the 60. If you're holding this on a longer term perspective, are you going to be terribly bothered about what's going on in these very fast time frames? The only point at which you might be bothered is if this trend monitor continues blue on these fast time frames and then starts to appear over on the 15-minute. And if you're trading an hourly, for example, once it starts to appear on the 15 and perhaps even down to the 30, that is telling you pretty loud and clear that this is quite a strong change in sentiment, and therefore something that perhaps you ought to be paying attention to. And that really encapsulates, and that's why I've set these charts up, and I've done it on some of the other workspaces as well. It really does, I hope, bring home to you the importance, first of all, of using multiple time frames, not least of all because what the indicators reveal, but in addition to that, what the candles and volume profiles will reveal, because as I've said many times before, and as Anna said, overlaying one candle on another to arrive at a hammer or an upthrust, whatever it may be, is very simple. We can all do that in our heads. What you can't do is overlap 4, 5, 6 candles, and that's the power. The other power of using a multiple time frame approach is it then reveals in other time frames things that you would not normally see. For example, if I just pull the 60-minute up, on the 60-minute, one of the things that would have certainly set the alarm bells ringing, we had the volatility triggered. This was a trap move on last week. This came in. We would expect the market to congest. It didn't on that occasion, but it has on the next one. Whenever you see these volatility triggers, this is price moving outside the average true range. It immediately alerts you to the possibility of the market congesting and possibly reversing. And we've seen that here for some time. That's for the last, what we're on the hourly, last 2 or 3 hours here. We're in a phase of congestion. It doesn't necessarily mean the market is going to suddenly reverse. It does on occasion, but at the very least you expect it to move into a congestion phase and a pause point, reinforced even more so by the fact that you're trading at the volume point of control at this point here. What we're seeing now is a possible deeper move. We've got this support region below, which is now in the process of being breached if this does indeed hold. But of course, we're coming to the end of the session, so we've always got to caveat that with what's going on now and what light to follow. But if this were in the mid-session, those are the sorts of things you would be looking at. You would be looking at those signals and signs which appear in all the other time frames. And then, of course, your benchmark, if you will, your let's just pull that out a little bit. There we go. The background that you're trading against is then on the daily chart, and even if you're an intraday trader, it's always beneficial to have the daily chart visible somewhere so you can just keep a perspective on what is going on in the overall time horizon, because when you're trading very close to the market, it's very easy to lose perspective, and what appears a big move on a 5-minute chart is actually just a blip on the daily. And you can see what's been going on today. It's very clear. We've had this very strong down candle, very little wick to the bottom of the candle. And the other reason for looking at the daily chart is also gives you a perspective on the volume profile associated with the VPOC. Again, it's back to this whole issue of using multiple time frames to give you different perspectives on what it is you're doing. As I said earlier, there's no flicker on the trend monitor there. We transitioned into red. We've come up here. We've come to the volume point of control. We've rolled over today, and it'll be interesting to see what the volume is when it closes off later on. So I just wanted to walk you through the ES there, and that really apply to any of the other charts as well. Some decent selling coming in here right at the end of the session. You can see we've actually transitioned now back into red on the 5-minute. Just pop that up full size, make it easier to see. So we've got some decent selling coming back into the market here again. Trend monitor's actually flipped back onto red. The trend line, this yellow line, is now diving back below the fulcrum of the two. So it's diving back into negative territory. That resistance region there, that held firm, was never actually breached at all. And we're now looking lower down the chart. We've got some half decent price support here. We've got very little in the way of volume profile here. So if the market were to continue lower and we weren't coming to the end of the session, then we might expect that to break through there pretty easily and move on down the chart into a further phase of bearish price action. Let's just pop that down again. Okay, let's go and see what else has been going on. Let's just go to, where should we go next? Let's just go to I've got the 3 indices up here. Oops, sorry. Let's just get rid of that, get right down there. There we go. This is the yen index, the euro index, and the dollar index. I've got the dollar index on 5. I know Anna had the dollar index up as well. Just move that over a little bit, make it a bit neater. Just pop that up. This is what the dollar's been doing. We had the rally. We had a big sell-off early part of the session. Then we've had the rally. Now we're into congestion phase. It's pretty much moving sideways as we come to the end of the session. The yen index, on the other hand, was there we go. That's the yen index. This very, very strong buying of the yen, obviously reflecting risk, and the fact that let's just click that over there. There we go. Very much reflecting the risk sentiment that was self-evident from the heavy selling of the primary indices, and that, of course, is always reflected in the yen flows. So that was on the 5-minute yen index. So again, it's using all these pieces of the jigsaw to help you assess what is going on and to give you confidence to take these positions, but more importantly, to actually hold them, because on days like this, they really are the money days. They are the days that you've got to hold a position to maximize what's going on, because the reversals were pretty self-evident. They were self-evident that they were only secondaries within the primary, as it was just a question of seeing through those and holding the primary and maximizing the profits on the table on these big money days. And it really didn't matter what you were trading. As I say, trading Forex, indices, commodities, it was pretty much all there. Let's just head over to, I've got a commodities workspace. Let's just open that one up. There we go. And what I've done here is slightly different. I haven't got different time frames here. I've actually got different markets, and they're all set to the same time frame. They're on 15 minutes. And I've got oil up here at the top left. I've got gold in the middle. Over here alongside, I've got silver. Down here, I've got some soft commodities. I've got corn and I've got soybean. And down here, I've got the dollar index, because if you're trading commodities, then obviously always you're going to have the dollar index up there or thereabouts. Just want to pull the gold chart up. Gold has, as Anna says, really benefited from it's had really a double benefit, because it's benefited from dollar weakness, and it's also benefited from a flight to safe haven, if you will, short term. When you get these strong moves, particularly in equities, then you will tend to see gold as a beneficiary. And if it's helped by weakness in the dollar, which it has been certainly for most of today at any rate, then you would expect to see gold, rising as it has done. That said, going back to what I said earlier on about longer term perspectives, gold for the time being is still heavily bearish, and the same also applies to oil. We've had a bounce in oil today, but in terms of the longer term perspective for oil, it's still very, very bearish. So if you're a gold trader, if you're an oil trader, a longer term oil trader, then you'll be looking at this as just one of those days where you've had some buying coming into the market, but it's unlikely to affect the longer term trend for oil, which is still very, very bearish. But that said, there's plenty of opportunities for trading oil against the longer term counter trend to the upside. And again, that was helped by weakness in the dollar. What's interesting about some of the softs down here, you can see this is corn, this is soybean. They didn't get much pull through from that effect of the dollar, which is quite interesting. And it's always a balance that you've got to, it's a little bit like trading in the Forex world, where you have to understand what are the drivers, what is the primary driver, because if the primary driver for a market is more dominant than, for example, in commodities than the US dollar may be, if the effect is something to do with yield or with trade embargoes, whatever it may be, that is always going to trump the effect that the dollar move may have, unless the dollar move is particularly strong. So whilst that relationship is generally true, and the inverse relationship is certainly one that holds pretty well, it doesn't hold all the time. And this is just an example where we've seen the dollar selling off, but we've actually seen weakness certainly in the softs at any rate, and that may well have been through a completely different metric and a completely different force, which is much stronger than that of the dollar. The impact of the dollar, rather. Let's just move to stocks time workspace. There we go. Still feeling my way with these, because I've literally set these all up this afternoon. And again, what I've done with the stocks here is to pick off half a dozen. Anna mentioned Alcoa, that's this one. Fantastic chart. It's just been downhill, and now it's starting to get a little bit of upside momentum, purely because of a little bit of pickup in the indices themselves. And just to talk for a moment about floating supply, the floating supply is actually pretty much what it sounds as though it is. It is about the ease with which a market can be cornered. If you're familiar with commodities, you've probably come across some of the great cornering episodes, of which I guess silver was certainly one, with the Hunt brothers way back, where basically they tried to corner a particular market. Sorry. Yes, chock finger as well, Anna reminds me too, was another one. Basically an attempt to corner a market and control the price of that particular commodity. And in a way, it's the same with stocks, because if you imagine a stock, a big blue chip stock, like GE, for example, which we talk about a lot here because it's an interesting stock to look at, the physical effort required for the market makers to control that amount of floating supply for a huge blue chip stock like that, it takes a huge amount of effort and resource to actually control that market. Whereas other stocks which have a far less floating supply, much more easily able to be managed and controlled, then that's really what it's about. And it's about the amount of control that market makers can exercise in terms of pushing the price around and managing the floating supply of a particular stock. And really that's what it comes down to. So if you are trading stocks, you do have to understand that these big blue chip, the floating supply is a key aspect of looking at stocks, certainly from an intraday perspective. I mean, really these comments are aimed at intraday trading. If you're looking at investments, much more stock investment over a longer term, then the same doesn't apply, because your time window, going back to that particular aspect of trading, is much, much longer. You'll be looking at holding those for probably weeks, months, maybe even years. So that aspect is not so important. If you're trading on an intraday basis, or certainly over a matter of days, then it is important, and it's important to understand because it will be reflected in the price moves that you can expect to see in that particular stock. But this is just a great move on Alcoa, and this one, as Anna said, we both pulled this one up independently and along with others. But of course, in addition to not only what's happening in terms of the stock price itself, it doesn't automatically follow that if the indices are falling, then all stocks will fall in price. It's not that straightforward. I wish it were, but it's not. But nevertheless, if you've got some weakness in the stock, then what will happen on the indices, if the indices are falling strongly, on those stocks which have a bearish sentiment to them anyway, it will be reflected more strongly. In a falling market, if you've got a bullish stock, it will certainly be reflected in a bullish stock, but it won't be reflected so strongly. So in terms of the price action on a bullish stock in a bearish market, you might see a narrow spread up candle, you might see a narrow spread down candle. But on a bearish stock in a bearish market, you're going to see a widespread down candle. And that's the other aspect that you have to understand is, yes, to some extent, all boats rise and fall with the tide, but they rise and fall at different rates depending on their bearish or bullish sentiment prior to that particular move for the day. What's interesting about this particular chart also, as you can see, we've had this minor rally at the bottom here. The trend monitor has actually transitioned into a bullish phase, and we've gone through the color spectrum here. So we've had the transition into bullish, but we've then had this volatility candle triggered on this 40-50 cents price move, and we've now got a congestion phase building. We've also got the volume point of control, so adding further. What's also interesting is, and very simple little VPA lessons, where you can see the price action here has fallen over 2 candles. We're expecting it to be in here anyway, which is fine. But when we're looking at the volume on these 2 candles, look at the way it's falling away. So you've got a double width candle, in other words, twice the price move here for less than the volume on this one. In fact, probably 2/3 the volume. So what is that telling you? What it's telling you loud and clear is that the selling pressure is diminishing on these 2 candles, and you've got this price action here on much lower volume. Now, obviously, you've got to caveat that against the framework of where we are in the session, but nevertheless, when you see that sort of thing happening, it's telling you pretty much that in this trend higher, that the selling pressure is pretty weak. It's falling away, and we've got this anomaly on the second candle where we've got a widespread but falling volume. So it's very unlikely that this market is going to collapse all the way back down here again. It's possible, of course it is, but it's very unlikely, just looking at those two candles and those two volume bars, that is likely to happen, because you've got falling price and you've got falling volume, and moreover you've also got double the price action here for less than the volume here. So that is telling you, it's giving you a nice little signal that, don't be frightened out of the market, sit tight, let's carry on higher, which is what we seem to be doing right now. Volume's building here, looking at it from, and putting aside the fact that we're coming to the end of the session, which we literally are in the next few minutes. But if we weren't and we were just trading this under normal circumstances, what will we be looking at now? Well, we've got some decent rising volume here, some decent price action. Yes, we're at the volume point of control, so we'd want to be clearing that before we actually, if we were in this position, we'd be holding it quite happily for the time being on the expectation of possibly further rotation around the volume point of control. But then above that, we've got some resistance here, and we've got some minor resistance here. So if we got to 33.65 odd with a decent clear and some decent volume, you would expect it to move on higher. We've got a relatively low volume node here, so that's not too much issue. Light resistance here and relatively light resistance up at 34.10. So all things being equal, if you were holding this, you wouldn't be too frightened of the market at the moment. You'd be sitting there waiting for possible further congestion. And if we clear this one, then happy days. We've got very little in the way of either price congestion or volume congestion above to hold things back. Sorry, went on a bit longer on that one than I was expecting, but it's a nice chart to talk to. Let's just have a look at one or two others. Wix, that was another one that came up. The technology took a bit of a battering today, certainly on FinViz. I think that was certainly one of the worst sectors. I must admit, I've not paid much attention to the NQ because I've been on the YM all day. But I suspect that's it's been battered a bit as well, certainly because all these stocks that were coming up as 2% plus down on the day were coming up in the technology sector. We've got a lot of volume coming in under this candle. Big anomaly there. What's it telling you? Well, it's telling you they've got a lot of effort and not much result from it. So is that likely to go very far? Answer, no. And, that's the short answer to that one. Just have a look at IBM. Just if I can grab that out. Can't get that out from under the chart. Sorry about that. I'll have to go back to that one. Where are we? That's GE. That's AA we've done. That's IBM at the top there. What's this one? This was another one I pulled up, I think, from from FinViz. Again, very negative on the day. Trading around the volume point of control. Pretty much, similar picture. A lot of these stocks now. And the issue when you're trading short, as Anna said, is it's another factor if you are going to trade stocks short, and you have to, because you can't go into this market as a day trader or indeed a short-term trader and think that you're just going to buy the market all the time. You can't. You've got to be able to trade short, and it is a little bit more complicated. It means the broker has to borrow the stock from someone else, which you then own as a short seller. And in addition to that, you also take responsibility for any dividends that are due. So, you just have to be aware of what you're doing. We've got some decent volume coming in here as well. So some pretty decent selling under this candle here. Looks as though it may be breaking further to the downside, but we've literally come to the end of the session now anyway. So the market's actually closing now. Where should we go now? Let's just have a quick look at, I think we've covered all the markets there. Let's have a quick look. We did commodities. Yeah, we've done the index. Just to go back to, this is on the, I've said this is the non-time-based workspace. And this was the ES on the Renko. And all I would say is that, and I've got the tick here as well, but that's all starting to close down now. The old tick speed is falling away as the markets close. But if you're trading on a time-based chart, I would urge you to use non-time-based charts such as the Renko to help to keep you in as well. They are just fantastic. They remove the noise from the market. They make things much more clear-cut. Yes, you see the reversals and everything else, but they will help to keep you in. It works in exactly the same way. You get these support and resistance regions. The trend dots work fantastically on the Renko. And what the Renko optimizer also does on NinjaTrader, and it works in pretty much the same way on the MT4, MT5 platforms, is that it allows you, it delivers the optimal brick size for that market that you're trading. So whatever you choose, I won't change around now, we're on 10 at the moment, but you can change any of these time frames, and what the indicator will do is optimize for you and deliver the precise brick size that you should be trading at that particular point of the session. Brick sizes change, markets speed up and slow down. A lot of traders think, oh, well, I'll go with 5 or 2 or 3 or whatever it may be. Well, that might be right, it probably isn't, because markets speed up and slow down the whole time. And that's what these indicators do. They give you the optimal setting for that particular instrument at that particular time of the trading session. And if you try it half an hour later or an hour later, you'll find maybe it's changed. So you slow down or you speed up. So you're always trading at the speed of the market. It's no guesswork. It does it all for you. And it works great with the trend dots, works great with the trend monitor as well. But I'd urge you to use it in combination with a time-based chart also. Are we okay do you want me to pass back to you?
Yeah, it's almost time to finish.
Okay.
Is there anything else you want to add to that?
No, I think I'm pretty much done. That's on the tick chart. That is another non-time-based approach, which basically uses tick. And if you're not familiar with these approaches to trading, then the principle is very simple. It removes the element of time from the chart and takes a different metric. In terms of the tick chart, you're basing that on, this is a 2,584 tick chart. So in other words, every time 2,584 ticks have gone through the market, the candle closes, whether that's in a nanosecond or a microsecond, however long that takes. So it's purely independent of time. And the same is true of the Renko. The governing metric for the Renko here is we've got this set to 10. And what that 10 refers to is the instrument. We're on the ES. And on the ES, you have 4 ticks in a point. So we've basically got 10 ticks here. In other words, 2.5 points. So each of these bricks here will be worth 2.5 points. And if you remember what I said earlier, index traders really look for 3 or 4 points on the day. There's a bucket full of points coming out of this market today. And these are the days that you really do need to make some serious, serious money. I'm going to stop there. I'm just going to pass back to Anna, and if there are any questions, I'll try and answer them. Apologies, I have the chat box always closed when I'm in full flow, so apologies for that. Just switching screens, bear with us.
Something that we've been talking about, well, certainly mentioned in the past few sessions, and that is the Camarilla indicator that we developed for NinjaTrader. We also, obviously, we have it for MT4 and MT5, and support and resistance levels are hugely important in whatever you trade. It doesn't matter whether it's stocks, forex, commodities, indices, what else? Bonds. It really doesn't matter. They're levels that are important to the market, to other traders, and traders are always looking for ways of trying to put them into some kind of what I call a hierarchy. You know, what's more important? That's why Fibonacci is used so much by traders. You know, they have measure their retracements. They can be used for stop loss. They can be used for price objectives, etc., etc. The reason we used Camarilla as opposed to Fibonacci, it was just something that has been around a long time, and it really does work really, really well. What I've done here is I've actually got, this is the daily gold chart, and we can see here where the price is at the moment, and it's at 1224.60, and you think, well, you know, it stopped. It actually did reach I don't know what the high was today. Let me just put the data box on it. Hopefully that'll bring it up. Sometimes is my cursor all right, David, this time? Oh, fine. On my other machine, it's a real problem. Right, the high today has been 1226.50. You think, well, you know, what's so special about 1226.50? Is it some magic number? Well, it could be some magic number. And when you put something like a Camarilla over on a chart, and I've kind of kept it as simple as possible, just some candles, the levels here, we only have the levels tiny over on the right hand side, but I think I'm actually going to get that changed so that the lines draw straight across, because originally we were putting these on the main charts, and the reason why we didn't have long lines was because it looked really confusing with the VPOC and the accumulation distribution levels as well. But by putting them on a separate chart next to perhaps your trading chart, you can see here, this is the R4, this is resistance 4. The Camarilla indicator that we've developed, we've actually got 6 levels. Most calculations come up at 4. And it's great because it tells you why it stopped. This is the R4 and the S4 are 2 very, very important levels. Because in the protocol, if it actually closes above the R4 or closes below the S4, then that's taken as potentially a kind of breakout, a successful breakout. Now, obviously, we use this in conjunction with volume price analysis, but it also tells you, well, you know, on the daily, if it manages to get above this, you know, 1226 today's high, where's it likely to be going next? Well, on the daily, we've got the next one, which is up here, 1236, something like that in that region. And the way we've developed the indicator as well is these levels that you see on the daily chart, they stay here for the rest of the month. So on the faster time frames, the values are recalculated as the session closes and then reopens. But it's just really interesting to have something on your chart that will just guide you to say, well, not only explain why perhaps a price has stalled at a particular level, but more importantly, it's stalled at that level. Is it going to reverse? Is it going to need more volume to actually push higher? And with regard to the volume underneath this candle, that was Friday's candle, which is a reasonably widespread, reasonable volume underneath it. And today we have I know we have a wick to the bottom of the candle. We have this little wick to the top. We know why it stopped, but the volume, you want to see a little bit more positivity underneath this candle. So we'll have to see what happens with gold. But when David and I talk about volume and price action on a chart, we happen to be speaking about gold. But it almost doesn't matter what the ticker is. It doesn't matter whether it's a stock, it's gold, it's a forex pair, it's an index. The lessons are universal. They will once you've learnt the basic lessons, you can apply them to whatever you're trading or investing. But you certainly need something. If you don't want to use a Camarilla, by all means have a look at Fibonacci, and certainly the volume point of control here. This is where the price actually bounced off, and it looks to be certainly a reasonably successful breakaway from this hugely, you can see here, move over to the left, the degree of congestion that we have had at, it's 1200, the iconic $1,200 per ounce for gold. And again, one of these levels, prices, value, whatever it is, it's what the market thinks, what traders they invest, if you like, but their belief system into these values. And in some ways, today's market moves, if you like, and in the bond market, it's traders believing or only wanting to believe certain things that the Fed Fed members have been saying. It's an interpretation of what they are saying, and it seems so, you know, everybody seems to have the same opinion about interest rates. But we will wait and see. Tomorrow that might change, who knows. And talking about tomorrow, that's when we are back, when we'll be looking at the Forex market. We're actually back at 7 o'clock London time. I should have made it 7:15, but it's 7 o'clock. But no matter, we will be up bright and early. So I hope you can come along to that as well. Meantime, just very, very quickly, the suite of tools, as I said, are from our quantum trading company, and today we've only been looking at the ones for NinjaTrader. They are the ones that don't have the Forex element to them, and they are $749 for the complete package, but you can buy them on an individual basis, or you don't have to pay the whole lot up front. We do offer an easy payment plan, and we also offer a 7-day money back guarantee. And if you do want to know a little bit more about them, if you head over to quantumtrading.com and hit the NinjaTrader tab in the navigation, these are all the tools. That's the full package. That includes all the Forex ones, and there are videos and lots of support pages there, so you can you can discover more about them. And somebody asked about a recording. Yes, it is recorded, and it goes up on YouTube. We have 2 YouTube channels: my own, which comes under Anna, the moniker of Anna Cool, and this Quantum Trading YouTube channel as well. And finally, this is my new sister. I'm just getting to know it. If you do want more information, you can drop David at quantumtrading.com an email. You can certainly email me, Anna at annacooling.com, or helpdesk@quantumtrading.com. So anything you want to say, darling, or is that it? Brilliant. Thank you so much for coming along. I hope you've enjoyed it. I hope you've certainly perhaps learnt something that perhaps you weren't aware of before you joined us this evening. We always try and include, go over lessons, perhaps, you know, bring in new stuff all the time. There's always something to say about the markets. And if we don't catch you tomorrow, hopefully you'll come along next week, which is it a Monday? I'm not sure if it's a Monday, but if you watch out on your emails, because we're coming into the run up to Christmas, we'll be changing the sessions around a bit. So anyway, whatever you're doing, have a great day's trading, have a great week's trading, and we'll catch you next time.